Good afternoon and welcome to JumpStart's special webinar series with KeyBank. Today we have Ricardo Thompson and Juan Adorno from KeyBank for our second of a 3-session series on mastering your money to improve financial wellness for business owners. Today they will be talking to you about debt management specifically. I'm Lauren Smith-Petta, and I serve as JumpStart's Director of Education. JumpStart strives to provide you with access to the knowledge and resources you need to make your small business bigger and better. You can always visit our website to explore some of our other educational opportunities for small businesses and tech companies. Before I introduce our presenters today, a few housekeeping items. This presentation session will be about 60 to 90 minutes with time set aside for Q&A. Our presenters may ask you to participate throughout, so please place your comments in the chat. Please also make sure that your responses are going to everyone, not just hosts and panelists. You may need to make this change or selection in the chat when you bring it up. You should also be able to see the Q&A, which is a great place to put your questions as they occur to you, and our presenters will address them at the end. Also, at the end of today's session and in a follow-up email, you'll receive a brief survey. We appreciate your feedback. It allows us to continue to bring in wonderful experts and entrepreneurs to teach valuable lessons. All right, without further ado, allow me to introduce our presenting subject matter experts today. We have Ricardo Thompson, a Cleveland native who has been with KeyBank for nearly 7 years. He began his career as a part-time teller and worked his way up to branch manager, a role he has now held for the past year and a half. As a small business owner himself, Ricardo understands the unique challenges of entrepreneurship and is passionate about helping small businesses thrive. Beyond his work at KeyBank, he is actively involved in his community and volunteers with the Class Act, a nonprofit organization dedicated to social and health awareness initiatives aimed at improving lives. We also have Juan Adorno joining us. Juan has over 15 years of experience in financial services and is Vice President of Small Business Program Management on Key's community banking team. He began his career at Legg Mason Global Asset Management in product management and strategy, and later supported small businesses as a commercial relationship manager at True Fund Financial Services. A former small business owner, Juan is dedicated to helping entrepreneurs with business growth and access to capital. Outside of Key, Juan volunteers with Columbia and Iona universities, mentoring business owners and empowering entrepreneurs. He holds a BBA from Bernard Baruch College and an MBA from the University of Vermont. That being said, welcome, Ricardo. Welcome, Juan.
Thank you. So good morning, Jump Starters. Welcome to our workshop on debt management. So we'll just jump straight into it. Thank you, Lauren, for that exciting, awesome introduction. So let's look at the agenda and learn about some of the topics that we'll cover. So last week, we learned about the importance of credit scores and reports. So today we're gonna go to building on that knowledge and focus on giving you realistic perspective about debt. So by the end of today's workshop, you'll be able to understand why people find themselves in debt and the most common types of debt, use and analyze budgeting and debt management strategies, compare various debt management solutions, and create a personal plan for how you're going to manage your debt. So let me see. So how many of you have felt the effects of debt in your life? I know I have. Maybe paying off debt has prevented you from saving money and forced you to live paycheck to paycheck. It may also be possible that debt has caused some tension in your home. So debt may impact you in a way that is simply just not being able to go out for dinner as much as you like, or not being able to accomplish personal goals as far as traveling. I know me, I like traveling. Debt is something that millions of people deal with. And learning how to manage debt is one of the most important things a person can do to improve their financial health. So before we go ahead, we want to jump into some pre-assessment questions, designed to guide the knowledge, prior to the workshop. So I want you to write your answers in the chat and we'll just go through the first two. So question one, in addition to money issues, what other effects can debt have on a person's life? Number two, what is the first and most important step in managing debt? So I'll let you guys read through those options and I'll let you pick which one you think is the best. And you can drop your answers in the chat. The chat is always interesting for you newcomers. Okay, okay. I got some good answers. Okay. All right. Some people said D. Some people said C. I got D and C. Okay. Okay. I got a few people that put C for number two. So I'll give you a second.
I just heard that chat is disabled. That is a setting issue, so just give me a hot moment to fix
Oh,
that.
okay. No wonder why all the answers were coming from us.
That's right. Give me just a moment.
No problem, no problem.
Okay, everyone should be able to contribute to the chat now. Thank you for your
Oh,
patience.
awesome, awesome. Okay. So if you didn't get a chance to answer the first two, okay, we got them. Oh, there we go. Yeah, we got them coming in. All right, I see D for one, C for two. I see one for D. Okay, yeah, yeah. I like the participation. Awesome, awesome. Thank you, Sonia, Janet, Diego, Gladys. Who else? You coming in kind of fast. Jessica, Myron. Thank you. Okay. So now let's reveal the answers to question one and question two. So for question one, in addition to money issues, what other effects can debt have on a person's life? The answer is D, all of the above. Money issues can affect so many different areas of your life, and that's why making a budget and just understanding where your money goes and how you spend it is so important. Number two, what is the first and most important step in managing debt? Answer C, creating a solid budget. So no matter how much money you have, it's always important to create a solid budget. I'm pretty sure you guys have heard of in your personal lives, people tell you to set boundaries, and that's kind of the same with money. You want to set a boundary for your money. You want to have a budget of what you're going to spend on and what you're not going to spend on. So creating a solid budget is so, so, so important. Okay. So let's move on to question three and question four. Question three, which of the following debt management strategies is considered risky and should be fully researched? And question four, which of the following is not true of bankruptcy? So I'll give you a few seconds to answer those questions, and then we'll go over the answers. Okay, I'm checking out the chat. Yeah, I see something from Gladys. I like that. Okay, yeah, digging in. Gladys said, budget is elusive when faced with predatory interest rates. Yeah, that could play a big part. It definitely could play a big part, and that's why it's so essential when it comes to budgeting, because I mean, like I say, it really doesn't matter how much money you have coming in, if you're not knowing where it's going, it's just so easy for a lot of things to fall on the wayside. Okay. So I got some good answers coming in. I see A for three, D for four. Okay, I see C for C for 3, and then D for 4. Okay. All right, awesome, awesome. So let's reveal the answers. So number 3, which of the following debt management strategies is considered risky and should be fully researched? The answer is C, debt settlement. And number 4, which of the following is not true of bankruptcy? And that answer is D. All of the above are true. And I would say that all of the above are true. In addition to that, bankruptcy is not for everybody. So everybody's situation is different. So a lot of what you want to do concerning bankruptcy, it really depends. And that's why it's always good to seek a bankruptcy expert before you decide to go into bankruptcy and kind of make some moves for yourself. So let's move on to the last round of questions. Question 5. What is the name of the debt management strategy in which you pay off the debt with the lowest balance first? And number 6, what made debt, when may debt consolidation be a good debt management strategy? So I'll let you read the answers and I'll give you a few seconds to put your answers in the chat. Let's see. Okay, Gladys has a awesome question. Gladys said a debt consolidation can alter original terms, which may have been better and may extend payment over time more than original. On that one, it really depends, because different companies have different expectations of who they lend to. So it really depends. It's not a black and white answer to that. You know, so that's why I say when it came to bankruptcy and settlements and things like that, everybody's situation is different and every institution is different. Sometimes it may be better to do a debt settlement. Sometimes it may be better, to not. So, but I think debt consolidation can be a good thing, you know, but it does have the ability to alter original terms. It just depends on what institution you're dealing with. So, it's no black or white answer to that one. So we'll go over the answers for question 5 and question 6. Question 5. What is the name of the debt management strategy in which you pay off the debt with the lowest balance first? That answer is B, the snowball method. And that is when you start off at the smallest and you keep on going till you get to the highest amount of debt that you have. Question 6, when may debt consolidation be a good debt management strategy? That answer is D. All of the above are good reasons to consider debt consolidation. Awesome, awesome. So, okay. So now let's look at the reality of debt. So over 75% of all American adults are in debt. Do you know the average, or did you know that the average American has about $38,000 in personal debt? And you can see how this is broken down by age group on this slide right here. So a growing number of Gen Zers have taken on some debt now that they're old enough to get loans and credit cards. The average debt for this group is $22,000, with student loans listed as the highest form of debt. For millennials, credit card bills are the leading source of debt. On average, millennials owe $42,000 in debt. Gen Xers, home mortgages are the primary source of debt. Gen Xers also carry 39,000 of additional debt on average. Now, baby boomers age 50 and over have the second lowest amount of debt, carrying 33,000 on average. Now, surprisingly, according to a recent study, credit card debt is the primary source of debt of this group, though. Okay. So now we're going to take a quick poll about debt. So how do you think having debt could negatively affect your life? So choose the best responses on the poll. And we'll discuss. You got four choices. You got mental health, relationships, life goals, and planning for emergencies. So I'll give you a few seconds to drop those in the chat. Okay, I got some people to say all the above, A and D. Nice, nice, nice. Okay, awesome, awesome. So the truth is that being in debt can affect all these things. So being in debt causes us stress and can have an impact on our relationships. 21% of people say debt has caused household tension. 31% says that it has impacted their health. Plus, 15% of millennials say that they held off on getting married and having children because of debt. So when we have high amounts of debt, we have trouble saving for retirement or a down payment on a home, which both helps us to plan for the future. So this is a case of about 30% of millennials. So as you can see, the effects of debt can seep into many different parts of our lives and can have a serious and lasting impact. So the only solution, debt management, which is why we are here today. So before we get into a deeper discussion about debt management, we need to really explore what is debt. So when you think about the term debt, what comes to mind? What is your definition of debt? And I want you guys to drop that in the chat right quick. What is your definition of debt? Let's see what we think the definition is, and how do you see debt? Gotcha, gotcha. I see money borrowed. Good answer. Good answer. Yep, yep. Types of debt, good and bad. Okay, okay. Financial obligation that negatively affects your net worth in the short and long term. Nice, nice. So I see some awesome answers. Okay. Future sacrifices. Gladys just said all of the above. All right. Well, that's a good start. Um, so I got another question. What are some different types of debt? So many different types, but what are different types of debt? And you know what? I'll even put my answer in the chat. And then you guys can tell me if I am right. Okay, I see some good ones. Credit card, lines of credit, student, student help. Yeah, up all those. Yep. Awesome, awesome. Okay, great, 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 great. We got credit cards, medical bills. Good answers, good answers. Debt is where your future income is necessary to pay, and debt where there are assets which can pay the debt as desired. Yeah, there you go. Good thought. Yeah. Awesome answers, you guys. Awesome. So let's get into what is debt. So there are many different types of debt and many different ways a person can get into debt, which is why we see debt connecting to many different sources. So the definition of debt is money owed for products or services purchased on credit. Now, what is interest? So interest is the cost of borrowing money and where the borrower pays a fee to the lender for the loan. The interest, I'm sorry, the interest is a percentage of the principal, usually charged annually. The interest percentage can vary depending on the product or service. For instance, in 2022, credit card interest rates were around 16% on the average, while car loan rates were around 5%. So when researching loans, it's important to consider the interest rates being offered. A lower interest rate means you'll pay less in interest to the lender over the life of the loan. On the other hand, if you're looking at a savings account, you want a higher interest rate so that you earn more money on your investment. Interest rates can either be fixed or variable. A fixed interest rate is typically a safer bet than a variable interest rate because of the amount you'll be charged over the life of the loan remains pretty much the same. With a fixed interest rate, there'll be no surprises on how much money you owe. So that rate pretty much stays the same the entire life of the loan. A variable interest rate is more uncertain because the actual amount you'll be charged can change according to your agreement and economic factors. So with that being said, variable interest rates can be attractive when current standard interest rates are high. So for instance, if an auto loan interest rates are high when you want to purchase a car, it may be advantageous to get a variable interest rate loan. So you may benefit when rates go down. Now, these are very basic definitions of interest rates and are not meant to really guide you on purchase decisions, on their own. But what's most important is understanding when it comes to debt management, interest rates can make the difference in your ability to manage your debt. So next, we're going to learn about types of debt. Now, did you know? Well, of course, some of you all actually said all debt is not the same. I actually saw in the chat some of you put good and bad debt. So you guys kind of just almost sent us into our our next slide. So we're gonna go over types of debt. So what do you think? And you guys can drop this in the chat. What do you think is the biggest source of debt in America? You got student loans, credit cards, home mortgages, and payday loans. Oh, we're firing on all cylinders on that one. Okay. I see credit cards. I see student loans. Okay, okay. Okay, there we go. I see some home mortgages as well. Nice, nice. Okay. Maybe the biggest now. Student loans, yeah, 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 yeah. Okay. So, in fact, mortgage debt and credit card debt are tied for the leading source of debt in America. Mortgage debt makes sense. Property is a huge purchase, but credit card debt, you got to think, where's all the money going? So, according to a recent survey, it's going toward entertainment, dining, nightlife accounts for 15% of all credit card debt, followed by hobbies, passion, personal care, clothing, and traveling. And believe me, I love traveling. And I love putting it on my credit card because I get the cash back. I have our 2% cash back card. So I love putting all my flights on my credit card as well. So so let's take a look at the chart on the screen to find out what people are charging in their daily lives. Okay, okay. So we see 15% on nightlife, 13% on passionate hobbies, 13% on personal care, and then 10% on leisure and travel. Okay. Yeah. And I can probably attest to that as well. All right. So even though there are different types of debt, not all debt is the same. Some debt is often considered good debt, if you believe it, and the rest is pretty clear. That's bad debt. So what do you think that means? What makes something good debt and what makes something bad debt? And you guys can drop your answers in the chat. What makes something bad debt and what makes something good debt? Nice. Bad debt only costs you. Good debt gains equity. Nice. I like that. Yeah, equity, building equity is or should be a huge part in our society. That is good debt is something that you need for everyday living. Bad debt is something that you really don't need. Yeah, I would agree. Definitely agree. The only debt is if the benefit outweighs the cost of the debt. Oh, the only good debt. Okay, gotcha, gotcha. The only good debt is if the benefit outweighs the cost of the debt. Okay, good answer, good answer. Awesome, awesome. So debt that provides you with a financial advantage is something that's referred to as good debt. And because the financial rewards you receive from the purchase counter the cost. So that's kind of like who said that? J Scott Schaefer. That's kind of what you said as well. However, if the property does not appreciate in value, or if the mortgage loan carries a high interest rate, mortgage debt can be considered a bad debt. Similar to student loans are considered good debt because you're getting an education and it may increase your earning potential. However, if you take out a loan and never finish your degree, then that becomes bad debt. So the worst type of debt is I'm sorry. So the worst type of debt is considered the costless debt. This usually comes from using credit cards with a high interest rate to pay for things like dining, entertainment, when you don't have the money to pay it back. So some financial experts consider new cars to be bad debt because they depreciate in value as soon as you drive them off the lot. Now, even though good debt can can help in the long run, it's still debt. It's still money that needs to be paid back. So to determine a person's financial health, we have to look at all the debt, good and bad, and that brings us to debt to income ratio. So one way lenders and other experts may assess financial health is to look at something called the debt to ratio income. I'm sorry, just debt to ratio. So the debt to ratio is pretty much what it sounds like. The ratio of a person's total debt to their income. So to calculate the ratio, you add up all your monthly debt payments and divide that number by your monthly gross income. And that's income before taxes. So let me see. So let's calculate. So let's do some calculations. Let's calculate Adetea's DTI. So Adatia has a monthly gross income of 5,000 and total monthly debts. And I'm sorry. So her gross is 5,000, but her debts are 2,000. So I want to show you guys a debt formula. I want to show you guys a slide. So that way you guys can learn to calculate your DTI, so that way you can see how healthy your finances are. Okay. All right. So using the DTI equation, let me see. Yep. So using the DTI equation gives us 0.4. So a data's DTI ratio is 40%. So now with this one, I want you to, after seeing the last slide, I want you to be able to try to calculate your own debt to ratio. And matter of fact, Cam, can you go back to that last slide just so we can see how to calculate our own debt to income ratio? Okay. So I want you guys to look at that slide, and then I want you to, write down on your own, like kind of plug in those numbers and see what you come up with to find out your own debt to ratio income. Awesome. So now we're going to go to accessing your financial health. So according to financial experts, your DTI ratio should be lower than 40% and below 37% is even better. If your DTI ratio is higher than you like, there are two main things you can do to increase your month. I'm sorry. There are two main things you can do. You can increase your monthly earnings, or you could just reduce your debt. So we like to make more money, but even if you find a new job, it may take longer to change. I'm sorry, it may take longer time to change your income, especially if you need more training or school. What we do have control over is how we manage our money. So the first and most important step in managing debt is managing your money and really creating a solid budget. So a budget creates cash flow. It allows us to live within our means so that we don't accumulate any additional debt and can work to pay off our existing debt while working toward reaching our financial goals. So now I'm going to pass it off to Juan to review how to create a budget for you guys.
Thank you very much, Mercado, and good afternoon, everybody. This topic of creating a budget, the whole concept of a budget is so important that we actually have a whole webinar focused on this topic. But for here today, we'll cover some of the fundamentals. And don't forget to, if you want to dive deeper into this topic, don't forget to register and attend. I actually saw in the chat that someone referenced the concept of wants and needs. So I could see that the audience, you guys are in tune with this topic already, because I saw the concept already come up in the chat. But really, many financial experts recommend that people create a budget following the 50-30-20 rule. The 50-30-20 rule is that 50% of your income should go towards your needs or expenses like housing and food. 30% should go towards your wants, because we still got to live life and have a little bit of fun. And for Mercado, that would be traveling. So 30% of your budget should go towards your wants. And then 20% should go towards savings and or additional debt payments, right? One thing that I want to make clear is that under the needs section, it's minimum debt payments, right? That's considered a need because you have to pay that every month. Now, if you want to make some additional payments towards the debt, that would go under the 20% bucket, right? And now this is not a hard and fast rule, but it's a recommended guideline, right? So there may be instances, for example, where your needs, including your housing, may be a little slightly above 50%, for example. Next slide, please. So now let's work through some numbers to really drive this point home. Let's look at Aditya's expenses and see if he is following the 50-30-20 rule. To calculate the percentage of Aditya's income that he can use to pay for his needs and wants, you'll take the totals, which is the 3,750 and the 1,000, and then divide them by his monthly income after taxes, or net income. Now, the concept of a net income is basically your paycheck. It's basically your take-home income, which is different from your gross income, which is the money before taxes. Now, this is the you multiply that result by 100, and that'll give you the percentage. So let's work through the numbers now. Let's review Aditya's expenses, and let's determine to see if you think that Aditya is following the 50-30-20 rule. So once again, it's adding up the needs and the wants that's on the slide here. And divide them by his monthly income after taxes, which is 5,000. And let's get some results on the chat. See what we got here. Not sure if I'm seeing the messages. All right, so Adia's monthly income after taxes is $5,000, right? And if we divide the total, which is 3,750 from his income, we see that he's spending 75% of his income in this area. And that's the calculation on the lower left side, right? So to calculate the percentage of needs, it's the 3,750 in the needs section divided by the 5,000. That would give you 75%. So you compare that to the 50-30-20 rule, right? The guideline is that you want to try to keep the needs to a maximum of 50%. And based on this calculation, they're at 75%. Now, a similar calculation with the wants, you have $1,000. You divide that by 5,000, and that gives you 20%. So if we look at Adia's wants and needs, he has only 5% remaining to pay down the debts or add to his savings. Now, based on the 50-30-20 rule, he should be trying to aim closer to the 20% of his paycheck towards savings. Yep. The last chat got that right. All right. So there's little room for savings. That's really the takeaway here, right? So based on these calculations, 75% of his budget is going to the needs, and 20% is going to the wants, which leaves very little room for savings and or additional debt payments. Now let's talk about savings and debt recovery. Financial experts recommend that any extra funds be applied to the following accounts in the following order. Number one, create an emergency fund with 3 to 6 months of living expenses. Number two, maximize your 401k retirement contributions, specifically if you have an employer match. Number three, pay off high interest rate debt and high APR debt. Number four, contribute 15% of your gross income to retirement accounts like your 401k. And number five, finally, pay off lower interest debts with anything more than the 20% save. And you could do this by reducing the amount of spend on wants. So let's talk about these recommendations because they may not be what we would expect, right? For every question, please drop your answer in the chat. Why do you think an emergency fund is number one on the list? I see folks say for emergencies, to cover common emergencies, loss of employment, all great answers. The emergency fund is a cushion so that a person doesn't have to borrow for those emergencies. All great answers for sure. Having an emergency fund enables you to cover the cost of emergencies to avoid taking on more debt, right? So it kind of ties back to the whole conversation about debt. If experts say that if you find it difficult to save 3 to 6 months of living expenses, experts recommend that at a minimum, you try to save at least $500 to cover common emergencies. We're talking about like a repair, small repair in the house, car breaks down, you need to get to work. At a minimum, we want to have at least $500, but ideally we want to try to save 3 to 6 months of living expenses as what's commonly called rainy day funds. Now, what about number two? Why is it so important to maximize the employer match on a 401k? Gladys, love that response. Yep, free money. Yep, free lunch. There's not too many free lunches out there, but that is certainly the key takeaway from why number two, right? Why maximizing your 401k employer match It's high up there on the list, right? If your employer matches your 401k contributions, this is free money. So not contributing the max amount is just throwing away this free money. Plus, the earlier you begin saving for retirement, the greater the potential gains made on your investment. Now, number 3 makes sense. We want to pay off those high interest debts. But if you look at number 4 and number 5, why do you think contributing to a retirement fund is more important than paying off low interest debts? Retirement accounts build up, absolutely, right? The wonder of the world, compound interest, right? A big component of retirement planning is how much time you have to save for retirement. And so the earlier you start saving for retirement, the more money you'll have when you retire. The amount of money you'll save paying off low interest debts is generally assumed to be less than the amount you'll earn by contributing to retirement early. So as you see, there's a strategy involved in paying off your debts. Many people focus on paying off debts without giving any consideration to savings, but this may be a huge mistake. In addition to debt payments, planning for emergencies and retirement are very important factors. Neglecting these areas may seem to help you in the short term, but freeing up the maximum amount of funds possible to put towards debt, it's a strategy that may cause you more financial hardship in the future. So now let's talk about how debt can affect your credit score. Being in debt can affect your credit score and have a long-term impact. As we learned last week, a credit score is a 3-digit rating that tells a lender how likely you are to repay debt. The best credit score you can get is 850, and anything 700 and above is considered a good credit score. If you have a lower credit score than that, it may be harder to get credit cards and loans since lenders may feel that you are unreliable in repaying your debt. It's all about being able to repay debt. Factors that affect your credit score include your payment history, your available credit, your credit history, your new credit, and then the different types of credits that you have. So now for another poll question, what is the most important factor in determining your credit score? Please put your answers in the chat. So J Scott, it would be the answer to both, right? So it would be the element that has the most impact one way or the other, depending on, whether it's it's low or high. So the answer is your payment history. Paying your bills on time is the most important factor in determining your credit score. And it makes sense, right? If you haven't paid your bills on time in the past, lenders believe that you'll be likely to miss a payment in the future. So now let's learn about 2 popular debt repayment strategies. Financial experts often recommend 2 strategies for paying off debt as quickly as possible. These are known as the avalanche method and the snowball method. The avalanche method focuses on paying off debts that have the highest interest rates first, while paying the minimum payments on the rest of your debts. The theory here is that high interest rate debt will end up costing you more in the long run. So it's good to pay these debts off as quickly as possible. The snowball method focuses on paying off debt with the lowest balances first, while paying the minimum amount due on the rest of your debts. The thinking here is that you can pay off lower balances more quickly than higher balances. Paying off these loans will reduce your debt to available credit ratio and give you a sense of accomplishment. So let's see what these strategies look like in action. Kaylee has the following debt. She has a major credit card with an interest rate of 26% and a balance of $3,000. She has a retail credit card with an interest rate of 22.3% and a balance of $800. Lastly, she has a personal loan that has an interest rate of 15% and a balance of $1,800. So question number one, using the avalanche method. Remember, the avalanche method is focusing on paying off the debts that you have the high interest rate first. So using the avalanche method, which debt would Kaylee work to pay off first? Yeah, it looks like we have a consensus. The correct answer is A. That's right. The avalanche method recommends that you pay off the debt with the highest interest rate first. And in this example, that would be the major credit card. And after that has been paid, you would move on to the retail credit card. Now, question number two, using the snowball method. Let's do a reminder. With the snowball method, you're paying off debts with the lowest balance first. So question number two, using the snowball method, which debt should Kaylee pay off first? There you go. You guys got these methods down packed. That's right. The snowball method recommends that you pay off the debt with the lowest balances first. And in this example, that will be the retail credit card. After that has been paid, you will move on to the personal loan. So great job understanding these two methods and applying these to Kaylee's debt. Now let's take a look at the do's and don'ts related to debt repayment strategies. So talking to creditors is number one on the list of do's, right? Communicating with creditors may be the easiest way to manage your debt. When you don't pay your debts, creditors must spend money to keep contacting you. Therefore, it may be in their best interest to help you stick to a payment plan. Try requesting a lower monthly minimum payment or even a lower interest rate if possible. And if you're having trouble paying your bills on time, you may even request a deferment. A deferment postpones your debt payment for a little time, allowing you to get your finances in order. You may also consider credit counseling. Credit counselors are usually nonprofit organizations that assist consumers with budgeting and debt management. They can provide you with educational materials, help you create a budget or debt management plan, and may even negotiate with creditors on your behalf. And you can find a list of reputable organizations with the Financial Counseling Association of America or the National Foundation for Credit Counseling. Now, one thing to be very wary of credit counselors that are not endorsed by these organizations. And if you are not sure, contact your state's consumer protection agency. Debt consolidation may be recommended if you have multiple high interest loans. This could be the case if you carry a balance on multiple credit cards, have more than one student loan, or even if you have many kinds of high interest rate loans, like a combination of car loans, credit cards, personal loans, etc. Debt consolidation involves taking out a new loan with a competitive interest rate. So basically an interest rate that's smaller than your current existing loans. And now your smaller loans are then transferred to this new loan. And what this does is that it reduces both the amount you have to pay each month and the total number of bills that you have to worry about. This option may be helpful in managing monthly payments and paying off debt in a timely manner. Now, finally, hiring a debt settlement attorney may make sense for your situation if your debt is overwhelmingly high and your wages are in the process of actively being garnished. And note that this is different from hiring a debt settlement company, which is on our list of don'ts on the next slide. So now let's talk about the debt repayment don'ts. These are some things that you should not do. Don't close credit card accounts. That's the first rule. Avoid just closing out all of your credit card accounts. While it may seem like a good idea to cancel your credit cards when you're in debt, if you cancel them, you can't use them, right? So by canceling, you may actually be hurting your credit score. And simply, if you don't want to be tempted to use your credit cards, put them in a safe or someplace inaccessible instead. Don't borrow from your retirement plan. Avoid borrowing from your retirement plan. You've worked hard to build up your savings. And if you borrow from your retirement plan, you may not be able to get back the earnings you've lost. Plus, if you take money out of your retirement account now, you'll be hit with some extra taxes and penalties at tax time. Don't hire a debt settlement company. Be careful about hiring these types of companies. Debt settlement is a very risky option. There have been many cases of debt settlement companies charging customers without delivering on their promises and providing bad financial advice. Experts warn to never pay upfront fees for debt settlement, so be on the lookout for these red flags if you consider this option. And finally, don't hide from the creditors. Avoiding your debt won't solve anything. In fact, if your creditors are unable to reach you, they'll probably send your debt to collections, which is a consequence that we'll talk about later. It may be possible to make a deal with your creditors on what you owe. So now let's talk about what happens if you can't pay your debts. One option is debt consolidation, which we will talk about next. Let's see how debt consolidation helped Carmen, who was struggling to pay bills for multiple credit card balances. Since she was having problems paying all her credit card bills, she decided to explore debt consolidation. Let's take a look at her credit card bills on the screen. Through her bank, Carmen was able to get a debt consolidation loan that freed her from the stress of managing multiple monthly payments and reduced her monthly payments overall. Even though her balance is the same after debt consolidation, her interest rate of 16.5% is lower than the interest rates for credit cards A and C, meaning Carmen will have less expensive payments. Debt consolidation is typically available through banks, credit unions, and online lenders. When researching debt consolidation options, consider the following. What is the maximum amount the lender will give you for debt consolidation? Is it enough to cover your debts? What is the average rate you are being charged in interest for all of the loans you wish to consolidate? Is the interest rate being offered for the new for the new loan lower than this? Right? You only want to enter into a debt consolidation if it's a favorable. It's not just to combine the loans for the matter of combining them. You want to make sure that you're getting a net benefit from them. Number 3, is the lender part of a reputable company, such as a bank or a credit union? Number 4, will you be able to make the payments on the new loan and stick to the repayment period set by the lender? For more information on debt consolidation, you may speak to a representative on our staff or consult with a credit counselor. Okay, the debt management strategies we just covered are recommended steps in getting your finances in order. But what happens if these strategies just simply aren't enough? What happens if you've gotten into a serious financial situation that can't be handled with the debt management strategies described earlier? Let's talk about what happens when you can't pay your debts. Debt can become overwhelming. You may be unable to pay your bills and collectors might begin calling. It happens. In fact, it happens to a lot of people. About 35% of adults with a credit history have debt in collections, owing an average of $5,178. And in 2019, there were more than 750,000 bankruptcy filings. So in this last section, we're going to talk about what to do if you have debt in collections or if you're considering bankruptcy. Let's talk about collections. When debt payments are past due and you haven't paid your bills for some time, your account is transferred to collections. Debt collectors have a poor reputation because some use scare tactics, threats, and harassment when attempting to collect on a debt, even though these tactics are not always legal. So for this reason, when your debts go to collections, it can be emotionally draining. It will also have a negative effect on your financial well-being. The debt will remain on your credit report for 7 years, and collectors may even sue you, which may lead to wage garnishment, liens on your property, repossession, or even foreclosure. Now, it is important to know your rights in this situation. The Fair Debt Collection Practices Act, the FDCPA, protects consumers from harassment from debt collectors. According to the FDCPA, debt collectors cannot call you before 8 or after 9 p.m. They cannot call you at work. They cannot talk to anyone else except your spouse about your debts. They cannot harass, abuse, or threaten you. They cannot misrepresent how much you owe, and they cannot use lies or deception to collect on the debt. It's important to know your rights, right? If you think a debt collector is violating this law, you can file a complaint with the Consumer Finance Protection Bureau or your state's Attorney General office. If collectors are calling and you're not sure what to do, or if you're not sure the debt is really yours, you may want to consult with an attorney to assess your options, especially if the debt may be beyond the statute of limitations or the legal time in which you can be sued for the debt. Now, a word on really important advice: try to communicate with collectors through emails or letters sent through certified mail so you have a paper trail of your correspondence should you need legal help in the future. The Consumer Finance Protection Bureau has helpful templates for corresponding with creditors and debt collectors on their website. Now, if you are still having trouble paying your debts, you can also consider bankruptcy. Bankruptcy can help give you a financial fresh start, but it's also a very serious step that you shouldn't take lightly. The two most common types of personal bankruptcy are Chapter 7 and Chapter 13. For Chapter 7 bankruptcy, you generally have to prove that you do not earn enough income to pay off your debts. Chapter 7 may be an option for people who do not have a lot of assets or property that could be liquidated to pay off some creditors. Versus Chapter 13 bankruptcy, which is an option for people who generally earn a reliable source of income and can pay off the debts within 3 to 5 years under a court-approved plan. Now, bankruptcy is serious. It's serious because it remains on your credit report for up to 10 years. It may also be time-consuming and a stressful process overall. And furthermore, not all debts are discharged through bankruptcy. So for instance, student loan debt likely won't be forgiven with a bankruptcy filing. However, bankruptcy allows a person to freeze the pressure of creditors and seek a fresh start. Now, if you are considering filing for bankruptcy, it may be helpful to talk to a bankruptcy attorney so that you understand all your options. This last activity is going to help you assess your own financial health in relation to your debts, right? So on a piece of paper, please record your gross monthly income, which is your income before any taxes are taken out, and your debts. Write down the total balance remaining on each type of debt account, right? Mortgage, credit cards, student loans, car loans, any other loans. And estimates are okay for now for the purposes of the exercise. Write down the monthly payments for each and the APR, which is the interest rate on each debt. And I know it could be hard to remember these exact figures, but do the best you can. Please take a couple of minutes to fill this out, and feel free to use your phone to access your accounts if necessary. You'll be able to work on this reference later if you choose. So we're gonna give you 5 minutes to fill that out. I know it's a couple pieces of information there. Feel free to, log into your accounts if you have to, estimate as close as possible. It's okay. It's going to be important to work through this exercise so you have something to reference later. So we'll give you a couple of minutes and then, start heading towards, summarizing, closing remarks and post assessment to drive some of the points home. You guys feel like you need another minute? All right, we'll go to the next slide, please. So today you have learned the following: why people find themselves. You now have the knowledge and skills to take control of your financial health. By managing your debt effectively, you can reduce stress and improve your well-being. So now we're gonna do a quick post-workshop assessment to test what you learned. But let me first cover what you've learned today. Why people find themselves in debt and the most common types of debt. How to use and analyze budgeting and debt management strategies. How to compare various debt management solutions, and then how to create a personal plan for managing your debt. All right, so I'm going to read out the questions and then give you a couple of seconds for participants to respond. Debt may impact a person's life in what way? And then the second question is, what is the recommended monthly budget ratio for needs, wants, and savings? All right. I'm seeing some good participation. Thank you. All right, so now let's see what the correct answers are. So question number one, it's D, all of the above. Debt may impact a person's life in what way? It's all of the above. It can cause conflicts in relationships. It can cause people to delay starting a family, and it can cause stress and health issues. Question number two, what is the recommended monthly budget ratio for the needs, wants, and savings? And the answer there is B, 50-30-20 rule. All right, we'll go to questions 3 and 4. I'll do the same thing. I'll kind of read the questions out loud. So number 3, which of the following is a debt management don't? And then question number 4, bankruptcy and collections are serious consequences of debt because. All right, I'm seeing some responses here. All right, the correct answer is B. Which of the following is a debt management don't? Borrowing from your retirement plan. Remember, it's going to have tax implications, and it's there. And for many 401k plans, is actually there can actually be a penalty as well for taking money out unless it's for very specific reasons. So, it's an economic disadvantage to, be borrowing from your retirement plan. Now, question number 4, bankruptcy and collections are serious consequences of debt because the answer is all of the above. They remain on your credit report for at least 7 years. They can lead to you losing your assets like your home or your car, and they're just very stressful experiences overall. Now here, last round of questions here. Question number 5, the snowball method is a debt management strategy in which. And then question number 6, which of the following is not true of debt consolidation? All right, thank you guys for your responses. I'll give it another minute. All right. All right, so for question number 5, the snowball method is a debt management strategy in which D, you focus on paying the debts with the lowest balances first. Question number 6, which of the following is not true of debt consolidation? The answer is B. It is dangerous and should not be considered without the help of an attorney. That is not true when it comes to debt consolidation. All right, that wraps up my part. Thank you all for the participation on the chat. Very much appreciate it. And I'm going to pass it over to Lauren for the Q&A part. Or
Absolutely. Yes. Thank you, Juan. Thank you, Mercado. We've had some amazing questions trickling in over the session. And I know that Jessica Best is also joining us, a key banker, regional representative who was also with us last week and was going to answer a couple of questions as well. So our first question was from Gladys, and she said, I declared war on debt decades ago and have been debt-free except for student loans until a health crisis. I had to dip into my life savings and yes, took our credit cards, but can't seem to climb out. Is there relief for debt incurred due to health crisis?
Yeah, so Gladys, I'm so glad you asked that question because I do feel that a lot of us have those unexpected life occurrences where we then need to rely on credit, and it can be challenging to, dig your way out once you've accumulated some of those balances. And I think in the second half, Juan shared some really great options of available resources. So just to kind of review those again, you can definitely reach out to your current creditors and explain that, you've had a life circumstance, and see if they have any programs available to help you with the current balances that you've accrued. Again, there are debt relief programs out there, but you do have to be very mindful to ensure that, it's not a scam, or that it's a reputable company that you're working with. But I really feel like the first place that you need to start is by having a one-on-one financial wellness review, whether that be with one of our KeyBank colleagues or your trusted banker or advisor, to really take a look at what outstanding debts do you have, and then work through some of those budgeting concepts that we just talked about as well. So, make sure that in your budget, you have the ability to make those payments, also wants and needs, and then make sure that you're also saving for future emergencies. And the other thing I did want to mention is, that banker or trusted advisor might recommend that debt consolidation where, we can talk about what your payment goals are or how long you'd like to make payments and really give you a customizable solution to help you achieve those financial goals. So I know we're going to share again the ability to schedule a one-on-one appointment with one of our KeyBank advisors, or you're welcome to visit your local bank or institution as well.
Thank you, Jessica. Gentlemen, do you have anything to add to that very comprehensive response?
Honestly, I think Jessica covered it very well.
Thank you.
Yeah, I would definitely agree. Definitely you want to start with your creditors because, like I say, like those institutions do actually have special programs set up for health crisis, flood cases, tornadoes. Like it's so many different programs that these institutions offer, but they may not be commercialized. So sometimes it just takes us just asking and going forward like that.
Great, thank you so much. Another question we have is for DTI, does mortgage include property tax? And is it the credit card minimum balance, or this is if you don't carry a balance?
Yeah, so it does depend on how your payment is scheduled for your mortgage or set up for your mortgage. If you do include escrow in your mortgage payment, that taxes and insurance obligation will be included in your mortgage payment. If you are not escrowing, that is not going to be included. It will just be that minimum mortgage payment. And then as far as the credit card minimum balances, yes, you're absolutely correct. If you do have a balance, that minimum payment is going to be what's against your debt to income. If you don't carry a balance on that specific card, it'll be 0.
Thank you so much, Jessica. Anything to add, gentlemen, or we can move on to the next question?
Yep, I think she said it. Yeah, we can move on.
Wonderful. Another question we have is, and I saw one of her fellow attendees answer a response to this as well, but Gladys was wondering, have any of you heard of Scott Hilton's Credit Secrets program? Is it legit? Does it really work?
Yeah, I'm not familiar with that specific program, but there are a lot of different programs out there, and a lot of them base their program on a lot of the concepts that we talked about today, whether it be avalanche or snowball. And so a lot of times these programs give you access to some of those tools that we just shared with you. Again, we would be happy to meet with you one-on-one and really find out more about your specific goals and help connect you to the right strategy to help you achieve that goal. But again, just, be mindful of like a financial commitment to some of these programs, as sometimes they can be costly and you do have access to them at no cost through your financial institution or online. So that would be my guidance, and I'll definitely be doing some more research on Scott Hilton's specific program.
Right, right. And was it Gladys that asked the question? Is that what you said,
Yes.
Lauren?
Mm-hmm.
Yeah, yes. I'm definitely glad you asked that question, Gladys. So I guess just to, be authentic, I haven't heard of the program, but I know in the past I've tried some different credit programs and things like that. So I don't want to say that, the things don't work and things like that, because I do agree with Jessica that they're going to give you a lot of tips and advice that we've just went over. But from what I've seen in my personal experience, a lot of times it's just easier to, pay off your debt. That money that they're going to charge you on getting these programs and things like that, that money could simply be used to pay off the debt that you're trying to inquire about with that company. So, like I said, that's just my personal experience. But yeah, that's just what I think, I haven't heard of it though, but I definitely think it's worth doing the research on it though. But definitely you can get with your financial institution, and that does come with free of charge.
And I just want to double down on, like, especially with personal financial questions, we can have a list of like kind of different steps to take, but it's so individualized in nature that the default option is really to try to get some form of a financial wellness, consultation, so that you can really dive into your own personal scenario, whether it's with like a KeyBank, a JumpStart, reputable, organizations that are going to give you the kind of insights that, the stuff we're going to recommend. You can look it up with the state's attorney's office, the Consumer Financial Bureau. There's always publicly available sources to be able to track back, whether or not these different sources are legit, right? So, but I do want to just double down on like that financial wellness consultation, which is free, it's complimentary, and it's important because these situations are just so individualized.
Great. Thank you so much. Yeah, we will circle back to the financial wellness clinics right at the very end that Juan is referencing, that is sort of part of this series. The next question we have is, we talked about the avalanche and the snowball methods. Which does it the fastest and which costs the least interest in the long run?
Yeah, so the debt avalanche method saves more money than snowball because it really prioritizes paying off the debts with the highest interest rates first. However, on the other hand, the snowball method can be more motivating because you're really attacking those smaller debts first and seeing those paid off and closed from there. So, it really, again, depends on, how you're motivated. Is it seeing that, you're making, you know, more of those like tiny balances go away, or are you just interested in saving money? Then maybe avalanche is better for you. But again, it does also depend on your specific scenario, what those balances are and what the interest rates are. And again, we'd be happy to sit with you one-on-one and show you the difference between both of those concepts.
Absolutely. And I think it also depends on your current financial situation, because every situation is very unique. So sometimes clients can't do the avalanche method, and it's better for them to start off at the snowball method. So it just really depends. Me personally, I'm a fan of both, but like I say, it just depends on your financial situation and what you can do.
Awesome. Thank you. We only have two more questions left in the Q&A. Um, Myron is wondering, what is the best free mobile app for this kind of budgeting that shows all of your financial information, your debts, etc., in one place?
Yeah, so Myron, I would suggest starting with your financial institution's mobile banking app. Sometimes there's some great tools accessible to you there that will easily sync to your bank account. So a lot of that information is filtered in. Some other popular apps, Good Budget, Quicken has an app called Simplify, Rocket Money, NerdWallet are all very popular apps as well. And a lot of those can also sync up to your bank account and also any credit card companies or anywhere where you may have debt obligations. Also, a very popular one is just using a simple Excel sheet as well. I know that's where I use my budget. It's retained in an Excel sheet where I can easily access and make changes as needed. So just some recommendations to get started. And again, we'd be happy to help you set that budget and get you set up on the right app for you.
You know, Jessica just keeps taking my answers.
I'm excited today.
Yeah, I would definitely, you know, piggyback off that. Like I know us here, I mean, we have such a great online budgeting tool within our app, and that's the one I use. So it just pretty much tells me just so many different things, you know, my debts, it tells me my net worth. It's a lot of good stuff within your financial institution's budgeting app. And you can, like she was saying, connect those with other apps as well. So, yeah.
The only thing I'm an Excel guy. I keep things pretty, you know, I try to keep things pretty easy and basic, but I'm also personally I'm a firm believer in the easier we make it for ourselves, the easier it's going to be to kind of stick to the habits. I feel like it's all about habits. And so when, like, for example, with savings, like the moment you get your check, just put some portion to your savings, right? And just, that has to just be automatic. I believe that just like with fitness goals, like if it's not a lifestyle, it's not going to be sustained. So it's just, you got to just create that habit. And ultimately, you know, it'll be sustained. Those are just my 2 cents. Those are just my 2 cents on that.
Well, you know what? To add to that though, now that you say fitness goals, so actually I'm a personal trainer as well. And I know that to be 100% true. You know, the more you make something a habit, you know, that's when you really start to see results. So even on a saving side, you know, putting that money aside initially, or even maybe setting up automatic transfers every time you get paid. So that way you don't have to trust yourself to do it. You know, your online banking or the system automatically does it for you, helps in that area as well.
Thank you all so much. We have time for the last question in the Q&A, maybe a parting shots kind of thing, and then we'll wrap. David is wondering, how do you rebound from credit card debt after job loss?
Yeah. And again, that unexpected life occurrence that really sets you back on, you know, the financial plan or goals that you had in place. I think the first step is really building a plan. And I think it's having a conversation again with your banker or trusted advisor to really understand what outstanding debt do you have, and then build a plan on what's the right strategy to help you pay that down and get it paid off. And so we would love to talk with you one-on-one in our financial wellness reviews that we'll be having on site on the 26th, to really look more at your specific situation, to give you advice.
Yeah, absolutely. Kind of like what Juan was saying. And I'll just bring it back to fitness again. It's just like when you're trying to reach a goal, both of us might be trying to lose weight, but he may need more cardio. I just probably need to stop eating sweets all day, you know? So it's always a different answer, you know, for everybody, you know? So it's kind of hard to, you know, give like a black and white answer, you know, to those type of questions.
Yeah, it's tough. Like one individual may have a collection of like 4 or 5 different debts. So maybe it's debt consolidation, whereas someone else, it may just be a lot of debt in one card. I mean, we can honestly sit here and talk about a lot of different scenarios, but you know, the insights that we shared earlier in regards to like the different types of strategies, you know, those are the kind of well-tested different sets of strategies, and then just coming back to your specific situation, right? And just applying it to your specific case.
And just remember, you have a resource too. within myself and within my partners here at the branch as well, because I know you guys are only like 5 minutes away from our branch. So anybody on the call, feel free to stop in, even if you don't have an account, even if you don't want an account, if you just want to come in and talk, get advice, go through a review of your finances, we can do that for you as well. So don't be shy.
And with Mercado, you get 2 in 1. You get yourself a financial expert and you get yourself a health expert, 2 in 1.
See?
I love that. Lots of goal setting and goal meeting if you use Mercado.
Health and
Thank you
wealth.
both. There it is, health and wealth. Thank you both so much for your time today. Thank you, Jessica, for chiming in here and helping us out. Thank you to our audience for participating as you did. I want to mention these clinics and the last session of this series that we are offering. So our financial wellness webinar series with KeyBank continues next week on Wednesday, the 19th at 11 a.m. There it is, regarding budgeting and use of funds, which I know applies to a lot of you as entrepreneurs and business owners. You have to register for each webinar individually to get the join link. So that link is now in the chat. You can review all of the webinars, including that one and other events at jumpstartinc.org/events. Also, we've alluded to it a lot on this call. The cherry on top of this webinar series is the in-person financial wellness clinic, in which you can sit and talk, no strings attached, one-on-one with a key banker regarding everything you've learned in this series and the implications of those things on your businesses. That link is also in the chat, and you can also scan the QR code on the screen. Once again, at the end of today's session and in a follow-up email, you'll receive a brief survey. We appreciate your feedback. It allows us to continue to partner and bring in experts like these to teach valuable lessons. That's all we have. Thank you, everybody. Thank you, KeyBank. Thank you, all of our wonderful attendees, and we hope to see you next week. Have a great afternoon.
Thank you, everybody.
Thank you.